And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, turning intent into execution. That's how ABSA are invested in Africa's energy future. Good evening. Welcome to the program. I'm Stephen Grootes. 8 minutes after 6. I have to say, and I don't know nearly enough about the members of the Public Investment Corporation to say whether I'm happy, sad, whatever. We'll hear more about them from someone who does know more about them in a moment, from Xhanti Payi. But I can't help but feel that I've yet to come across someone who thinks the current structure of the Public Investment Corporation, where a deputy minister is the chair, I don't know anyone who thinks that's working. I mean, I don't see it. So I don't know why we're sticking to the plan. Now, maybe it's just all happened too quickly. And let me just be fair for a second to the finance minister and all the others involved. Maybe it's all just happened too quickly. They need to appoint a board, and then we'll go and sort of do all the structure. Maybe. I would have thought, though, if you really wanted to restore faith, this would have been the moment to say, well, look, here's the new board. This is their job. This is what they're going to go and do. And then to then say, okay, we're also going to look at the structure. Because as I say, I know no one who says that it is actually working. I just don't see it. Anyway, we'll hear more from Xhanti Payi. I'll give you a very informed view in just a moment. Interesting to see about gold prices. And for a long time, you know, we've been watching how gold prices have been rising. Then the US and Israel attacked Iran, and gold prices sort of went the other way. And part of it has been central bank buying. And it seemed that central bank buying actually slowed down a little bit. Now it's speeding up again. I want to understand why. Juan Carlos Artigas is the global head of research at the World Gold Council. I think that's going to be an interesting conversation. You'll hear from him in a couple of moments. I don't know if you've seen the headlines around the new acquisition of Pepkor. So they're buying basically a fintech company that will then be merged into their own fintech company. And basically this is all, I mean, from what you can see about Pepkor, they really do know what they're doing. But the company they're buying is called Shop to Shop. It'll merge with Flash, which is the company they already own. But the Pepkor CEO, Peter Erasmus, owns a big stake in Shop to Shop. So obviously he benefits from the transaction. And I must just say, it's not just him that this happens. I mean, remember Barlow World and Dominic Sewela? It happens in many other cases, actually. And you see it internationally too. We'll just talk about the conflict of interest in these cases. How do you manage that? Wayne McCurry, you'll remember him, a veteran market commentator. He's agreed to come back on the radio and just tell you a little bit about his views on that. I think that's going to be interesting. And then Science Tonight, that despite everything, the high fuel prices, the inflation, that, the Old Mutual suggesting people who are earning are actually pretty confident about the future. I'm not entirely sure where the optimism comes from. I must just remind you of one spot of good news today, though, which is that not exactly from now, but from fairly soon, you'll only need to get your driver's license renewed every 10 years rather than every 5. Now, look, the process has been getting easier and easier. I went to the Waterfall driver's license center last year, and it was very quick. I mean, the only delay was me getting back there to go and pick it up. It was very quick. I was very impressed. But I do wonder exactly when this is going to come in. And then the next thing, obviously, is that your driver's license should be on your phone anyway, so you shouldn't have to carry it around. I've had some very quick and wonderful driver's license experiences. One was at Waterfall last year. About 10 years ago, I had a terrible one at Randburg. You just waited and waited and waited. It feels like a different era now. The first time I actually got the kind of credit card driver's license that we have now, I waited in a very long queue, I think at Langlaagte. And there was another queue in about 2022, middle of the way during the pandemic, where, I remember them looking for my temporary driver's license. And I suddenly realized this was not done alphabetically. I was like, wow, how do you even begin to look? It wasn't done by date. I just couldn't work out how it had been filed. Your driver's license stories, please. The best and the worst. You know, the longest queue, the worst queue, the funniest person you met in a queue, and the best story, please. 072-702-1702. Good to hear from you as well. And 011-883-0702 and 021-446-0567. 13 minutes after 6.
The Money Show.
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
And DSTV channel 856.
Confirmation today, Cabinet announcing the Deputy Minister of Planning, Monitoring and Evaluation, Seso Mohai, will be the new chair of the Public Investment Corporation. He replaces a Deputy Finance Minister, David Masondo, who resigned last week after the huge furore over the suspension of the CEO, Patrick Lamini. The other board members include the former African Development Bank Senior Vice President, Swazi Shabalala, the former prosecutor, Omar Rasataba, and the Mondi CEO, Vivian McMenamin. Apologize for that surname. Xhanti Payi is an economist and strategist at Inani Strategies. Xhanti, good evening. I know you've been looking through this new board at the track records of the people appointed to it. So the chair was a finance MEC in the Free State. When you look at this group of people, what stands out for you?
I think, Stephen, for me, and good evening to the listeners, was really that the prosecutor and I guess the corruption buster, as it would be, in the sense that we know that one of the key things that emerged through the different issues, and I think, as I said, that emerged through the past few weeks over the struggles we've seen in the PIC that were reported at the rallies, was this issue around who is trying to do what and who's pulling what in the board. And so I guess you need somebody like us on the board who's got an eye for what is real and perhaps what might be a cause for concern in terms of what people's agendas may be, in terms of, I guess, the corruption that may be. So that was, for me, the main thing. But I must say, Stephen, perhaps just at the start, that it's amazing to me that one of the key issues that we are dealing with now is that one of the challenges that we are seeing about the chairperson is that actually, the one thing we are worried about is that it's actually this governance is written perhaps poorly, even in the legislation.
So, I mean, there seems, certainly, I didn't see any public announcement today of a plan to change that. And I mean, the Mpati Commission made findings that the recommendation was not followed in the case of the chair. And there seems to be no appetite for a change, at least publicly.
So at least publicly, Stephen, and there has to be some change, because I think we've seen the benefit of independence, and I think this is part of the issue that we have, because there's two things that I guess are pulling on each side. The one obviously being that obviously this is public funds. I guess these are people's also, but also very private funds, in the sense that these are people's pensions, and so this is not actually public money as many people have thought. And that, I guess, one of the things that people have said is that we need this to be to be governed in a manner that actually has public interest. But at the same time, we also know that these are very much private funds and private pensions. And these two things are very important in the way that we actually look at it. And I suspect that we're going to have to rethink this idea of a share that comes from the government and this, a very public kind of governance that we see.
I mean, it's interesting. The shareholder representative, who's the finance minister, has a huge amount of power, and yet probably more power than the pensioners whose money is being invested.
And certainly that is something that has been raised that's very, very important. The GPF and what voice they've got in this, and that's very, very important. And we've got to rebalance all of those things, especially as we think about these institutions. Remember, Stephen, that one of the key things that's very, very important when we think about public finance institutions, especially their transformation, both here at home and globally, is that we're not the only ones who are dealing with this issue of the so-called public finance institutions, people's pensions, and or public finances that are being used to obviously to support, public interests such as infrastructure, as we know, can be some of the projects that can be financed with loans or with equity in terms of what the PIC does. But it's also about how we actually are creating an environment or an atmosphere of collaborative investment that can work both with private and public monies in a way that actually gives us the outcomes that we want. And so we've got to really think this about what we are actually trying to do. We are not trying to do just one thing. We're trying to do a number of things with these kinds of funds. And so it's also interesting that we've got to try as far as possible to see what we can do in the management and the governance of these institutions to actually have that mix that allows us to be able to do a little bit more than what we've been able to do with what we think is public funds, or at least, with these public finance institutions in that sense. So what can we do to make sure that we are creating a system that is collaborative with both the private, banks, I guess, private equity, which actually the PIC in some sense has played. So we need to do better in this. The governance will probably be the thing that we do.
The other thing that's directly related to that is the amount of investment experience in the board, and there is some there. So, Patience Nkweto is Deputy Chair at the Development Bank. Lebogang Mogabodi has experience as well. It's an impossible question, Xhanti. Is that enough experience? Do we need some people who maybe have 20 or 30 years of doing nothing else but investments on the board?
It's a very important question, Stephen, and it's an important question because it's not just actually a question that we could ask of this board, but of boards in general and of governance in general. Remember, we've got people always say we've got a very youthful population, but we don't have many very useful people, assisting us in our institutions. But what is the thing? But we do certainly need tried and tested people against, new ideas, against, the old school and the new school experience. So this is very, very important. So there's no doubt that that question is critical, and we actually have to manage that. I know, for example, I chair an organization that we've been grappling with some of these kinds of thinking about what do you mean by you need youth? What do you mean by you need expertise? What do you need? We need experience, but also new ideas. We need to challenge the institutional frameworks because obviously we know that there are certain things we haven't done very well. So, old experience or, institutional thinking perhaps is not what we're going to need going forward. But certainly we need that mix, and that we're continuously going to need to re-challenge our thinking as we go forward. This is what I'm saying about these institutions are not what they're going to have always been. We're going to need them to do a little bit more and think differently. And this is not just a South African issue, it's a global challenge.
It's so interesting to watch that because, it's a point that's been made so many times and is worth remaking. The assets under management of the Public Investment Corporation have the ability to change South Africa's economic trajectory if managed well.
Absolutely, Stephen, in a very fundamental way. And in the way that also they also have the mandate, in terms of being able to take stakes in an important way, but also to lend in another way, to also stay long term, because obviously that's what you can do with this kind of institutional financing, that you could stay 20 years in an investment so that you could actually create meaningful change rather than, short term kind of capital that needs to, come in and go out as quickly as it comes out. So all of these things are present in this institution, and those are the kinds of things that we need to be able to achieve what we need to achieve.
I see the finance minister in a position where I think if he really wanted a structural change, he could make it happen. Do you think that over the next 2 or 3 years, there'll be a bit of peace? Everything will need to be stabilized. They'll have to sort out Patrick Lamini as well, because I don't know what's going to happen to him now. He's been in court, and I had a look at some of his arguments about why he should not have been suspended. That's surely the first hot potato.
That is going to be a very, very difficult thing for the board because they have to stabilize this organization. As I said, one of the key things I've been watching over the past few weeks has been that, right? The positions that are critical to running an organization like this at a critical time as we are facing now, and with the challenges that they have. You've got to really try and stabilize the organization itself to make sure that the CEO and maybe some of these acting positions that people have been talking about, so that is something that's going to be critical for them to do as quickly as possible. But they've got to obviously play a fair game, and there's going to be legal issues that we're going to be facing for a while. So I guess the chairperson is going to have to be quite crafty and quite thoughtful about how he actually leads this board to be able to achieve some of those things. And I guess the shareholder is going to have to obviously play that role as well, because obviously they have an important influence there that is set in law. So certainly these are critical things that we have to look at, Stephen, and I guess most people are going to have their eyes set on this. And of course, clearly the president has an interest in this because he has put this in his office, in a sense, by having a deputy minister in the presidency. Yeah.
Xhanti Payi, thanks so much. The economist and strategist at Inani Strategies. So much to get into with the PIC. 22 minutes after 6.
The Money Show with Stephen Grootes
on 702.
702.
You remember the big financial global story affecting us at the start of the year was gold prices, that amazing rise to, what was it, $5,000 an ounce. Then the conflict started in the Middle East. Prices started to drop. But the big factor that had been driving gold prices over the last few years had been central banks buying more gold to ensure they had enough during a difficult geopolitical times. The World Gold Council saying in the first quarter that buying by central banks slowed, now seems to be rebounding again. Juan Carlos Artigas is the global head of research at the World Gold Council. Juan Carlos, good evening, and thanks so much for your time. So central banks were buying more gold because the world was less certain. I think some wanted to lessen their reliance on the US dollar. Then they bought less gold in the first quarter and now more gold in the second quarter. What's been driving those decisions?
Hi, Stephen. Thank you so much for having me. Great question. Look, to put things into perspective, central banks have been buying gold for quite some time, more than 15 years. They increased the pace of buying since 2022. And as you mentioned, in particular in Q2, their buying pace was quite strong. It was 289 tons, which is above the average that we've seen over the past 4 or 5 years. Now, to answer specifically your question, Q1 was a quite unique set of circumstances. The gold price increased significantly, as you mentioned at the beginning of the segment, and then it came down afterwards. There was quite a bit of volatility. For some countries, there was a need to, have liquidity and to be able to respond to pressures on the currency. And we saw some degree of selling or swapping gold by a couple of central banks. Overall, that plus a very uncertain environment around the world paused some of the purchases. And even though it was a net positive quarter Q1 for central banks, it was still significantly lower than average. But I think that as things normalized, as the price of gold stabilized, and the underlying need remains, which is diversification, hedging against uncertainty, geopolitical risk, all of these factors remains, the buying started to pick up.
I noticed during this period that demand in the jewelry sector has been lower, and clearly the price of gold must be one of the reasons for that. This is a terrible time to buy gold jewelry.
Well, not a terrible time, but it can be a difficult time, partly because of the price, as you mentioned. Naturally, as any other consumer / luxury good, as prices increases, they can have a great headwinds for demand. What is really interesting from our perspective is that even though the volume, the amount of gold that has been bought for jewelry is down, the value of that demand has increased, meaning that consumers are actually spending a larger share of their wallet into gold purchases, right? Maybe not buying as much in terms of volume, but spending more into gold jewelry.
When you look then, I know you're not obviously going to make too many predictions, but if you look at the sort of geopolitical risk that we're seeing now, the conflict in the Middle East, I think there's a risk that it becomes an entrenched conflict. Does that have a bit of a longer term impact on gold prices? You can't really do a counterfactual, but obviously that is having an impact on gold prices in some way.
Well, what I can tell you is that generally speaking, geopolitical risk does have an influence on gold prices. We focus on 4 factors that influence gold. Economic expansion, number 1, risk and uncertainty, number 2, opportunity cost, number 3, and momentum, number 4. Within risk, geopolitical risk is one of the things that we track, and we've done extensive analysis that does show that an increase in geopolitical risk has a positive effect on gold demand, specifically through investment demand and in part as well through central bank demand. Now, to answer your question, the gold price today does reflect some of the dynamics that we have seen over the past several years. And it is not just a single conflict, but I think that is the combination of the various geopolitical and geoeconomic risks and uncertainty that has been piling up and that investors are looking to manage. So there has been a structural shift in geopolitical risk that is sustaining gold prices. If that geopolitical risk were to sustainably decrease, we may see pressure on the gold price. But at present, I think that the market generally expects geopolitical risk to remain top of mind for many investors.
An entirely rational approach. Juan Carlos Artigas, thank you so much, the Global Head of Research at the World Gold Council.
The Money Show.
The markets.
28 minutes after 6, Viv Govender is a portfolio manager at Rand Swiss. Viv, good evening. Woolworths talking about a slightly tough quarter to the end of June. I mean, people will pay more for quality and convenience, but when things get tough, they might look somewhere else.
Yeah, I mean, often people talk about South Africa has been a bifurcated market in which there's like almost two different marketplaces. And the Woolies marketplace definitely serves the upper income in that bifurcation. But even that market segment apparently is being affected by things like the rising, uncertainty in the world, the higher fuel prices, etc. And they are starting to see some weakness coming through because of the slowdown in growth, because of what they are seeing in terms of the consumer coming under pressure. In terms of, the overall, different segments, we are seeing, some positivity. For instance, the food business is doing reasonably well, with growth in terms of to a still of about 5.7% on a comparable store basis. This is obviously a segment that is certainly insulated from the worst of the difficulties in the economy. Like I said, it's the upper income, but like I said, it's interesting to find that even they are being affected by what's been happening right now.
A stellar day for Mondi's share price. So yes, they made a lot less money, but it seemed to me investors quite like the idea that they're going to reduce their capex.
Yeah, look, I mean, this is, again, another one of those things where you're seeing some slightly, with Woolies, they also saw some slightly disappointing numbers, and the market treated it quite positively. Again, with regards to Mondi, we are seeing some, difficulties coming through for the company. The share price has been under pressure for quite some time, even though in the last month it's positive. Over the last 2 years or so, it's down quite significantly. The market is positive about a couple of things. Also, there's talk about the fact that there's strong order books and improving sales momentum. That also help the future of the company. But like I said, the actual numbers in the results themselves don't look that great, but the market reacted quite positively to it.
In the US, some astonishing things happening in the tech sector. Microsoft up, is it double digits? Their results beat expectations by a long way.
Oh, yeah. Look, Microsoft has been under a bit of pressure, despite the fact it was one of the first companies to get into the whole AI hype cycle. Remember, it was the first company to do a big investment into OpenAI. And it started to be really having a lead in that sector. It's not really done as much as the other AI companies have out there recently. But in terms of the results that come through, I think what we're seeing right now is a couple of things. Firstly, we are seeing that the data center usage is quite good. Remember, there's the Azure cloud system that comes from Microsoft that is quite powerful. And also, there's obviously some sort of traction coming through with AI. Many people that have used Microsoft's Copilot have said that it's not quite as good as the Claude attachment that you can get for Microsoft Office. But if they can basically work on that, there is huge ability to get you more functionality from Microsoft Office. You have an additional Copilot subscription that's attached. And Microsoft has shown in the past, for instance, with the browser wars, for instance, where they can start up with a less good in a way attachment to their own operating system. They eventually really compete in that case, actually remove any competition for the browser that they provide.
And very quickly, Meta down, going the other way.
Yeah, Meta comes out with spending spree in terms of what they're looking to do for the next couple of years. So they talk about a $279 billion lease plan for data centers, plus $130 billion or so capex spend on their own company. This is, I think, just further illustrating what's been happening in the AI space. We have seen some of these AI companies, not today, obviously we've seen a huge rally for things like Micro, SPHanics, and so on. But we have seen those companies under huge pressure for the last few weeks or so on some fears about what's been happening in the AI space. But when you have a company like Meta willing to spend hundreds of billions of dollars in the next few years on AI, that money has to go to somebody, and that's going to be the equipment providers. And again, the way I'd phrase it is this. Right now, we talked about Claude, etc. This is stuff we can see right now. The labs, Meta, Microsoft, through the agreements of OpenAI, etc., OpenAI, Anthropic, those guys are seeing systems that are probably 6 months to 9 months ahead of what we have right now, because that's the kind of likely to take it to be safer. those companies are investing a lot more. So we can expect AI over the next 6 months, 9 months, a year to show significant improvements over what we have even right now.
Veuve Govender, thank you very much indeed. Portfolio manager at Rand Swiss. Very interesting. Just after 6:30.
WhatsApp Stephen
On 072
702
1702.
21 minutes to 7. Well, before we talked about the Public Investment Corporation, I was asking for your best and your worst driver's license stories. In other words, getting the driver's license. And I've had some good experiences recently. I've had some terrible experiences over the years. Your view on 072 702 1702.
Hi, Stephen. Hope you're well. So I went through a bit of a trendy phase where I had a perm and a moustache, and I needed to renew my driver's license. So, I'm absolutely stoked that we have to renew it every 10 years. But currently, I am stuck with a very curly-haired character with a moustache on my driver's license for the next 5 years, which I'm not too sure whether I'm too happy about that. But it's Nazim in Johannesburg.
Nazim, that's great.
Hi, Stephen. On driver's license, sometime last year, there were like months on end where I just never knew where my card was. However, I did know one thing was that the card was expiring in November. So eventually November comes, I go and renew it because obviously I don't know where the previous one was. But fast forward to this year, a few weeks ago, misplaced it again. So I haven't seen my driver's license in about 3 weeks. But one thing's for sure, I believe it should be virtual. It's probably the only card that I actually carry, and that's why I misplace it as often as I do. I don't carry a wallet around. So where do you keep this thing?
So I suffer from that too. It drives me nuts. And I keep my driver's license in my wallet, and I'm forever, man, it's in the other, and when you're ferrying children around and you have more than one driver in a house, the chances of you moving cars on a daily basis is actually pretty high. Whoever's taking the kids will take the nice car or whatever. I find it incredibly frustrating. Got to go on the phone. Just got to go on the phone. And I know, thank you, that I could get a wallet thing for my phone, but I don't like those. They look fancy and complicated, and I don't like that. I like the clean, just sort of the phone, Anyway, I'm sure someone will come up with a solution one day. 19 minutes now to 7.
702 with Stephen Grootes.
Email him on stephen@702.co.za.
14 minutes now to 7. Or some fascinating developments around Pepcor's planned purchase of the fintech company Shop to Shop. It'll merge, as you know, with Pepcor's Flash business. But the Pepcor CEO, Peter Erasmus, has a big stake in Shop to Shop. So he would end up holding around 13% of the new business. I suppose, to put it another way, the new business would be owned by the company that he is the CEO of, and he will have a big stake in the new business. Now, he's not the only one. This happens from time to time. So remember last year, Barlow World, Dominic Sewela put together the consortium. They ended up buying it. He stood to gain there too, I suppose, and there were plenty of questions about a conflict of interest there too. There are plenty of international examples. Wayne McCurry describes himself as a man of leisure, but you and I know him as a veteran market commentator. Wayne, good evening. It's a wonderful privilege to invite you back to the Money Show, and thanks for coming on. So, you have a CEO who steers a process where the company they lead is going to buy or merge with a company they own. They stand to benefit. The conflict of interest is obvious. How should someone manage it?
Look, it's a very difficult one. And Stephen, as you said correctly, this has happened many, many times. So let's just maybe look at the overall picture a little bit. He owned a company before he became CEO of Pepcor. So there's no problem with that now. They're selling that company through to Pepcor. I have the greatest respect for Ian Kirk as the leading independent director in all of this. I trust his judgment and his integrity highly. So I don't think there's anything untoward about the process of buying the company. But the question arises now, should he retain his shareholding in the company once Pepcor has bought it? Because that could be perceived as a conflict of interest. So I think that's where the real challenge lies in all of this. I don't think there's anything wrong with the transaction that's going to happen, because this does happen. And I think, as I said, I trust their process. But it's going forward. Should should a managing director own shares personally in a subsidiary of the company where he's the managing director? Whether there will be conflict of interests, but there's the perception that it may in fact occur going forward.
And I mean, this could go in two directions. So there would be potentially a conflict of interest, as you point out, in him owning shares in the subsidiary of the company that they now own. But if you were to say for the transaction to happen, he should sell his stake now, well, he might not want to do that. And that would be a disincentive for him to lead the company to actually go through with the transaction that you believe is a very good deal.
Look, I think that is the right thing to do. I mean, I honestly don't know how you can get rid of this potential conflict of interest or the perceived conflict of interest if he retains that share in the subsidiary. So this, in my view, should be a logical part of the whole transaction. Is he gets a fair price for his shares, and then he participates in the upside of that business with the shares that he owns in his own holding company and whatever other incentive scheme the company has for their executives.
This happens from time to time. Should a company try avoid it at all costs? I mean, they would be foregoing this transaction if they were to avoid it at all costs.
No, I don't think they should avoid it at all costs. They've just got to sort out this minority shareholding in shop to shop.
It's actually quite likely this kind of thing will happen. So you'll have Company A, they're involved in a particular field. One of the best people to run Company A is someone with a lot of experience in that field, and they gain that experience because they happen to run, start, own, become CEO of Company B. So, yes. I mean, this kind of thing must actually happen far more often than you would think.
Yeah, it does happen. I can't recall anyone of any great magnitude in South Africa at the moment, but yes, it does happen. But going forward, as I've said, that's where I think the test is going to be, because there will always be a perception of a conflict here. And unfortunately, something like this does leave a bit of a sour taste in the investors' mouths.
So, I mean, one of the other questions that will come up is who made the first suggestion, who made the idea, and it might well not have been him. It might well have been someone else. He might have come to it relatively late. But to try and prove that to investors is probably impossible. Yeah,
look, I mean, I don't think that's that important. He might have said, listen, we want to do this business, and I'm a shareholder of this other company, which I'm sure they knew about, and they probably knew about that when they employed him. So it's not as though it's just sprung up now when they're looking at shop to shop. This must have been disclosed by him, because that would be the absolute natural thing when you employ any senior executives. You ask them, what are your interests? What shares do you own? What businesses do you own? What, et cetera, you and your related family and associates. So I think they would have known about this since he joined or before he joined. So I don't think that's the problem, whether he suggested it or whether some other investigation within Pepkor suggested it. This is the direction the company wants to go in. I mean, they've got a banking license. They've just bought a fintech business. They've got this enormous branch network that they want to roll out financial services to, et cetera, et cetera. So I don't think it makes much difference who suggested it at all. This decision to go in this direction has been taken by all the directors, and the whole board is behind it, and this is the way, along with just about everyone else in the market, sees fintech as a major growth area. So I don't think that's the issue. As I've said, the issue is what does he do with his shareholding now?
Wayne McCurry, really good to talk to you again. Thank you very much indeed. Wayne McCurry, of course, as you know, a voice very familiar to you on The Money Show as a market commentator. 8 minutes to 7.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
Well, the suggestion from Old Mutual today, despite the fact we're all facing higher fuel prices and higher inflation, most of us, certainly those of us who are earning, are feeling pretty confident about the future. Nearly half of the people earning more than 8,000 Rand a month are confident about the economy. 3/4 actually believe their own financial position will improve over the rest of the year. John Manike is the head of financial education at Old Mutual. John, good evening. Good to chat again. I mean, we're kind of assailed every day by news of high fuel prices, and this is going to go up and that's going to go up. Where's the optimism coming from?
Good evening, Steve. Thanks for having me. Well, it's quite an interesting observation to make from the stats that consumer confidence is recovering. More specifically, the economic optimism, because when we look at these numbers, it appears that 47% of South Africans are more optimistic or have more confidence in the South African economy. But remember, this is also based on the general perception of South Africans, and perception is perception, and it is a reality to those who hold it. But when you look at on the other side, I mean, if you look at the fact that there's still some challenge in terms of managing debt, we're still seeing a lot of people being financially stressed. So the recovery, or in terms of the confidence in the economy, seems to be benefiting more strongly those who are earning more, like those who are earning more than 30,000 a month, while lower income consumers continue to face significant financial pressure. So I think what this tells us is that South Africans have got divergent economic realities, and it does look like income does play a role in terms of the recovery of South Africans.
So I was going to say, I mean, the richer you are, the more kind of confident you are. And I mean, you would probably expect that in many places, actually.
No, indeed. I mean, if you look at it, I mean, people who apply for credit, the creditors, they tend to look at your profile, they look at your income, and the interest rates that they would offer you or below prime. I mean, those are some of the things that they look at. They look at, can you afford? I mean, things like your credit score, those things come into play. Whereas you find that people at the low end less might be having challenges in terms of accessing some credit or even getting a better rate. But also it might be a function of maybe struggling with keeping up with repayments, and given the rise in the cost of living.
Is the confidence backed up by what's actually happening? So people would feel confident of the future if their financial position had improved in the last year or the last 6 months. I mean, is there any evidence to show that, in fact, that is the experience, and that's partly where the confidence is coming from?
Well, possibly, because I mean, let's make this practical example. If you earn 50,000 Rand a month, for example, and your employer offers you a 5% increase, and then if the same employer were to give somebody who earns 10,000 Rand a month and they give them 5% increase, surely from a rand value point of view, there's a big difference there. Even though the other one might be paying higher tax, but the other one might be feeling a lot more confident because they're seeing more rands, whereas the other one might feel a bit discouraged. So that's why we're talking about this uneven recovery and these divergent realities. But having said that, debt remains a major concern because we're seeing most South Africans relying on credit, personal loans, and informal borrowing to manage everyday expenses, which signals ongoing affordability challenges. So you can imagine affordability challenges at the lower income level is more pronounced compared to those who are earning more.
I mean, the hope obviously is that the people who make financial decisions, they'll make them, when they get a little bit more money, they'll make decisions that make them wealthier. They'll save for retirement or university or the family or something like that, or medical aid. When people get slightly more money, is that what happens, or does it go somewhere else?
It does seem like, as much as we're looking at these divergent realities in terms of experiences and people's financial outlook over the next 6 months and the confidence in the economy, but the fact remains that what you earn does not necessarily improve your ability to manage your money. You can still earn more money and still struggle with financial decisions. So it's not a direct correlation to people's savviness. It just means that you've got access to more, a little bit more, compared to somebody else who is not. So there's certainly this growing disconnect between financial optimism as well as financial resilience, and not as many people are that financial resilience. But the income certainly does play a factor from these levels. Yeah.
John Manyika, thanks so much. Head of Financial Education at Old Mutual. Really do appreciate the time on The Money Show. It's 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, turning intent into execution. That's how ABSA are invested in Africa's energy future. 8 minutes after 7 the time. Looking forward to investment school, getting right under the skin of why a share price is at that price. What are the major factors that determine that? We'll speak to Makwe Masalela and Gary Boyson. Really looking forward to that conversation. Tutu Motsi is the CEO at Tamani in Small Business Focus this evening. Why the most valuable person in a small business shouldn't be its owner. How does this work? Its founder. Who should be? I mean, I know people who swear by the salesperson. Without a salesperson, without someone who can sell, you're in real trouble. That's what some people suggest. And of course, Siphumelele Zondi, he'll be with you in a moment. He's got lots to talk about in tech this week, I can tell you that. So I think that's all going to be very, very interesting. So a lot to come this evening. You know how to get in touch, 011 883 0702 021 446 0567. And your voice notes, please, on 072 702 1702.
702. Stephen is on The Money Show.
6 to 8 p.m.
It's been very interesting watching some of the economic fallout from the Football World Cup. And I'm not talking about the current spat between UEFA and FIFA. I have no doubt that's going to rumble on for a very long time. And by the way, I really don't think you could sell any of that to anyone else. I think it needs to stay in the hands of football, would be my view. But figures today from AB InBev, the international brewer. They make beer, among other things. And they were expecting a bit of a boost from the Football World Cup. They got a small boost. Their sort of organic growth, as they call it, was up just 0.9%. But I do wonder why you would think that, World Cup in the Northern Hemisphere summer would really do well for them everywhere, not just in the US, but in Europe as well. Doesn't necessarily seem to be the case. Now, I know that the World Cup famously is the only event of its kind, brings people together, lots of people watch it. But beer has kind of tended to be that drink. If you had to pick one drink that one alcoholic drink that most people have had at some point, the most people, it would be beer, I'm sure. It's kind of, you could argue, the gateway drink. Now, I suppose the question would be, is beer becoming decoupled, to use a phrase, from watching football? I don't know. Hard to know. Certainly, we all know that younger people are drinking less alcohol than older people, and that's a big change in society, and I'm sure a very healthy one in all sorts of ways. But just interesting to see the impact this is having on AB InBev. I thought with the World Cup, Northern Hemisphere summer, it would be a big boost. Doesn't seem to have been the case. 11 minutes after 7.
The Money Show, Tech Thursday.
Well, banks now don't seem to have any branches. When GoTime started, Time Bank, they had no branches. Pepkor launching their bank in 2027. Another one now, Airtel Money is listing on the London Stock Exchange. They're actually in 14 countries on our continent. And one of the big things they do is remittances. And the way that people actually think of banking really is changing. Our tech expert, Siphumelele Zondi, is looking at the Siphumelele. Good evening. Pepkor's bank, how's that going to work? Is it going to be a lot like how Time Bank or GoTime started?
Hello, Stephen. And yes, it doesn't seem like they've released much information, but when you think about PEP, you think about the stores that are all over the place because of who they're targeting, right? You find them in urban settings, you find them in rural settings, you find them all over. So you may think that the infrastructure is possibly there. So yes, in all likeliness, it's going to work in the way that Time or GoTime, or formerly known as Time Bank, is operating. But because the infrastructure is there, because of their shops that are already in existence, so you might find that things might be a little bit easier on them because they wouldn't need to partner with other with supermarkets and the like because of that infrastructure.
Okay, so what does all of this mean for kind of bricks and mortar banks? Some of those banks, Standard Bank's 120, 130 years old. They've always had a physical infrastructure. Is that the end of that? That must have some value, I would think.
Yeah, well, the branches sometimes are necessary if because there are people who still want to go in and ask a few questions. But when you think about it, think about yourself. And a lot of people don't usually go to the bank anymore. They have the app that sorts out a few things. They have numbers that they can call. And yes, you may need to walk in, but that's also because of the infrastructure of the bank that requires people to walk in. But if there are methods and ways that allow you to do things digitally and you don't have to go anywhere, you do it from home, you do it as you are on the move, wherever you are at a coffee shop, then that's the preferred method that a lot of people are using. But brick and mortar banks are still there, but even those old legacy banks, they're also shutting down quite a few branches as well.
I mean, there are lots of things to sort of look at in all of this. So, I mean, Airtel's launching on the London Stock Exchange. It allows a lot of people to raise more money for fintech in Africa. We've really seen a huge growth there. M-Pesa is massive. We've seen ABSA going into that. We've seen Southern African banks, I suppose I should call them, really investing in that quite strongly. I mean, that's really where the place is, where the sort of investment is at the moment.
And also, when you think about where Airtel started, there used to be a mobile phone network operator, like the ones we have here in South Africa. And sometimes when I'd land in a country and I'd look for a local network for however long I'm going to be there, if I choose not to roam and I want a local SIM card, that's what would happen back in the day. But they also decided to go into banking and mobile money as well. And that's where their biggest growth actually became, which is why it's Airtel Money. It's not the entirety of Airtel. It's not the mobile network operator that they're going to be listing in the London Stock Exchange. It's actually Airtel Money. It's the bank aspect of what they do. And yes, across the African continent, fintech, because of the African banking systems, and maybe this is also a lifeline for a lot of people who did not have actual bank cards or bank accounts across the African continent, because you mentioned M-Pesa, which was a game changer actually, and was an entry into this digital banking that we are now so comfortable with, because in a lot of African countries, people did not actually have physical bank accounts, and this could be for a number of reasons, because sometimes you don't have an address and the bank would want an address, and then it would be mobile money in the form of M-Pesa that started this across Africa, and then big banks adopted it, banks across the world then adopted that, but Africa was actually the start. So Airtel Money listing in the London Stock Exchange, that's also showing that fintech, digital banking is actually quite huge across the African continent.
Airtel deals in what they call mobile money. I mean, so what is mobile money? I mean, you can think of money in all sorts of different ways, especially now in the fintech space. How would you define it?
Well, mobile money is essentially us going cashless, and sometimes how it would work is that you can call it a till. So you, in a way, you would deposit cash, but in certain countries they try to regulate this a bit better than it does in South Africa. I think about, for example, in the case of Kenya, where in the matatus or public transports like our minibus taxis, you actually use your mobile phone in order for you to pay. In that the system there does not allow you to use cash, and this is how they've been also able to collect. The taxman has been able to collect revenue as well, especially in the informal market, and that's how mobile money has assisted across the African continent. These different methods that have been used in order to avoid using actual cash, and that's why it's been so successful across Africa.
So it's interesting because mobile money hasn't been that popular in South Africa. Now, is that just because the cash systems that we have, the way that you can do anything on an app anyway, is kind of quite entrenched?
That's basically it. In fact, when you think about it, M-Pesa did launch twice in South Africa, and they folded twice in South Africa, and that's the big reason it happened. So because most South Africans have bank accounts, and our bank infrastructure has been quite well developed, especially when it goes back to a time when the preferred method was cash. This obviously seems to be changing now, as you are seeing a lot of digital banks now starting to launch, and maybe more mobile money products could be launching as well, and maybe who knows, in future, maybe M-Pesa, which launched twice in South Africa, can decide that, hey, people are now comfortable with being cashless in South Africa. They're comfortable with using alternatives to normal banks.
Siphumelele Zondi, thanks so much. Our tech expert on The Money Show.
The Money Show. Small business focus.
Small Business Focus is brought to you by Capitec. Start up or scale up with Capitec, the business bank for everyone. I mean, often when a small business starts, it kind of feels like it's about one person. One person's doing most of the work. They have the vision, they have the thought, they have the social capital. They become, in a way, the whole business. Not always such a good way to go. Tutu Motsi is the CEO at Tamani. Tutu, good evening, and thanks so much for coming in. I really do appreciate it. So I understand how that happens, right? It's usually a small business. One person thinks, okay, I can do this. There's this niche or whatever it is. But that's not a great idea for them to be the most valuable person in the firm. Why is that?
Yeah, Stephen, I think, as you mentioned, usually at the start of the journey of any business, the founder is the most important person because they hold the vision and the dream of the business, and they probably know how to execute whatever product or service they want to sell to the market. But I think for the ability of the business to be able to grow and to grow sustainably, a business owner needs to think about how do they unemploy themselves. And unemploying yourself then forces you to start thinking about systems and processes which will ensure that, more people or someone other than yourself is able to help grow the business. And I think it happens sort of naturally in the growth stage of any business.
So what you need to do is stop doing all the legwork, all the sort of grunt stuff, the repetitive stuff, and get other people, create a team around that.
Ideally. And I think as a business grows, the type of work that you do as a founder should become more strategic, right? Because you're starting to get the right people from a talent perspective who can do the execution. And more importantly, you're starting to invest in the right systems and processes to be able to take over some of the grunt work, some of the repetitive stuff. Because, ultimately as human and cognitively, we should be doing the stuff that's really difficult, that requires sort of deep thinking, that requires, setting a strategy and really having a clear way of in which direction you want your business to go. So that's sort of what owners and founders should be doing as their businesses grow.
For a lot of people, the real problem is just finding enough customers, right? So you want to generate leads. Now, an owner will often generate the first leads and the first customers. You need someone, and I mean, I've seen someone come in who's just a salesperson, and they'll sell anything. And I mean, they can change the trajectory of a company. I mean, I'm not that person. I mean, just to be clear, but I've seen people who can do it. It's an amazing skill. How can you go about getting enough customers and getting enough business in that allows you to start thinking in that way?
Sure. And I think one of the myths about sales is that, it's personality link. I think there is an element of, very charismatic people or great salespeople, but it is a science. And I think why I say it's a science is that you have to at some point build a sales machine because, the three questions you typically want to answer when you're building a sales function and trying to generate sales outside yourself as a founder is really around, what are you selling, firstly? Who are you selling to? So have you clearly defined what we call your ISP, which is your ideal customer profile? And where do you find them, right? That's a question a lot of businesses ask themselves, yes, I want to sell a specific product to this target market, but where do I actually find them? And then the last one is the how. How do you reach them? So when you're building and thinking about a sales funnel and how to make it more scientific, those are the 4 questions that you want to be able to answer as a founder. They're not easy questions. And that's why, the companies that do figure them out do become these mega successful companies. And I think even if you look in South Africa's history in the last 20, 30 years, and particularly I heard you talking about sort of fintech and banking, you've got great examples in Capitec and GoTime who, 20 years ago, you wouldn't have thought a new bank would come into South Africa, but these banks have shown they've figured out who the customer is, how they get to them, and what they're going to sell to them. And once they've figured out those sales machine, they become sort of the massive entities that we know today.
That sales machine is so important. I mean, one of the problems is you can get attention. You can have an advertising campaign. You can say, I'm going to fulfill this need for you. You can do very well on the Insta. But then you have a phone call, or you have a bit of interest, or you have a message, or you have a something, and turning that into a customer, actually from that moment, getting the lead, into actually that person's money going into your company's bank account. That's quite a hard road sometimes, I think. I mean, part of it's the fun part, because that's why the founder created the business. They want to do, provide the service. Correct. But to actually get the money, get it all to come in, get it on a regular basis, that's hard graft.
It's incredibly hard graft. And I think in the initial stages, there's a lot of teething in figuring out what is that recipe. And I think then the next step is in how do you systemize that recipe? Because oftentimes, as you said, we're very quick as entrepreneurs and founders to celebrate getting the client or the sale, but then forget that there's an execution element to it, whether you are producing a product or delivering a service. And ultimately, how do you get that cash into the bank? A lot of the stuff is linked to building the systems and the processes and starting to learn your customer behavior, so that you're kind of always tweaking and shaping sometimes your payment conditions. As small businesses, you learn that, you don't just offer value upfront. Sometimes you have to stagger payment terms and maybe get value upfront from the customer as a sign of commitment. So I think those are sort of intuitively part of the journey as you're trying to grow your business.
You need systems and controls. Now, when it's just one person or three people, they all know each other and they know everything about each other. They know where they live. They spend time in the delivery car. They know how they're getting on with their spouses. They know all of those things. At some point, you can't do that anymore. You've got to go from the kind of 3-person WhatsApp group to systems. And when you go to systems, I can hear from the founders, the people involved at the ground floor, the groan. Oh, we've gone corporate. Oh, we've sold out. Oh, next we're going to have to do a feedback survey, Yes. And I can hear that. How do you do that? Because that's such an important part of scaling up. It's like the very point of it. How do you what do you need to have in your mind when you go around doing that?
Yeah. So my question typically when we deal with founders or business owners like that, I really go to the heart of what is their intention strategy-wise and for the vision of this business, because often we mistaken strategy with execution strategy.
Yeah.
Right? Because it's good to have a strategy. It's good to have a vision about, dominating a province or doubling your revenue and tripling your profitability. But you've got to be quite practical in that you need then a very strong execution strategy that will bring that vision to life. And so you can't really, in my view, have a strategy that doesn't have an execution view, and that view doesn't include systems and processes. Because practically, if you want to double your business, I can't imagine you doing it linearly by hiring more people. So you're forced to then start thinking about systems and processes. So to bridge the gap for most founders is tying it back to their strategy, to say, well, it's quite difficult to then realize that strategy without introducing, more people or more systems within the business. Yeah,
I would think that the systems now are cheaper than they've ever been. So many of them are free. You've got a free accounting software. You can, with WhatsApp, you can go to like 1,600 members. So no one can claim they didn't get the message. You will know. You will be able to say, if at the very least you can buy them each a 500 Rand phone, and the data stops becoming a problem. All of that stuff really must matter for a business. So the systems are not that expensive. The trick is to manage them, and to manage them so that your people are happy and that they work effectively.
Correct. And I think not only managing them, because of the plethora of what's available now, it's picking the ones that are actually relevant for your business.
Yeah.
I think we all know AI is a buzzword at the moment. Everyone is talking AI and infusing AI in their business, but it's all about the relevance of AI and how does it actually help you operationally. So yes, business owners are not requested or shouldn't try and adopt every available system. I think it's again intrinsically knowing what are the key drivers for your business and then making sure that the systems you introduce into your business are helping you scale that and bring efficiency. So the relevance of the systems you want to put in your business probably matter now than they did about 15, 20 years ago.
We've got 10 seconds left. Is your business your people? Your people make it?
Your people make your business. and your people can make your business great if they're supported by good systems and processes.
Toto Motsi, thanks so much for coming in. Really appreciate it. The CEO at Tamani.
The Money Show.
Investment School.
24 minutes to 7 the time. You'll have heard so many quite high-level conversations on Investment School, and I think correctly so, about why some things are good investments, why some things are not. We've had conversations about strategy, conversations about all sorts of things. Tonight, we're getting right under the skin of the whole point, which is what determines a share price. So why are some shares worth more than others? Why do some go up when others don't? Why? I mean, sometimes it's obvious. Valterra is a good example. They had great results yesterday. They went up dramatically. Today, a whole lot of platinum miners went up. So how do you work it all out? Gary Boysons, the portfolio manager and director at Rand Swiss, and Makwe Masalela is the founder and chief investment officer of Makwe Fund Managers. And thank you both for coming into the studio. Good evening. I mean, the obvious point is that when more people want to buy a share and fewer people want to sell it, the price goes up. When there are more sellers than buyers, the price goes down. That's just the beginning. But what's really going on? Makwe, let's start with you. I mean, the way that the economy is doing and the way that people perceive how the economy is going to be doing is going to be a big factor. And if you just take 10 seconds looking what's happening at the NASDAQ at the moment, you can really see that.
I think maybe we need to understand that what is the economy, you know. Basically, those companies which are listed, that's your economy. So hence, it's supposed to be that the market's supposed to be a reflection of what is going to be happening with the main economy.
There's a bigger question around share prices where this goes to, which is there will be the share price of a company now and the perception of what that company will be doing in the future, which is really all about AI investing. How important is the perception of what a company is going to be doing in the future?
Very, very important. And we usually say, you know, to put it in a simple way, that valuation of a company depends on what the buyer is prepared to pay. And the buyer will be prepared to pay maybe a higher price because it expects, or the perception is that that company going forward will do much better. Or maybe the buyer will say, nope, I'm going to pay less because the perception is that that particular company is not going to do well. So that element is also very critical, that what is it that the guys are prepared to pay for.
Gary, so this also takes us then to, in some ways, looking at a stock market and looking at the price of a share is about a battle over different perceptions of the future. You've got different people with very different views of the future, and that actually really has a big role in determining a share price.
Yeah, absolutely. So I think Michael said it well. The ultimate, if we really get it down to brass tacks, it's the value of something is what someone else is willing to pay for it. But why are you willing to pay for a share in the first place? Because you are becoming an owner of a business, and that business is going to return to you, hopefully through dividends or potentially share buybacks, the earnings that it makes. So when the economy gets better, you expect that business to make more money. You expect suddenly to have more profits attributed to you as a shareholder. And I mean, if you're looking at it kind of from a pure valuation point of view, you're trying to discount all future cash flows to get to the valuation today, because as an owner of a company, you can hold that company indefinitely and you can receive all of those cash flows as the owner. Now, of course, the challenge here is that, everyone is trying to predict what those future cash flows are going to be. And it's that kind of like that interplay that creates a stock market. That is a market. And everyone has different views, and some are right, some are wrong. And I think there's a survivor bias in markets as well. People that are regularly wrong tend to lose all their money. And people that are right tend to make more and get better. And that's what makes markets just as efficient as they are today, because the winners are the ones that get to continue to play the game.
Makwe, how important then is corporate earnings? So obviously, and I mean, Valterra is a great example. They had great earnings, but it wasn't just the fact that the platinum price was higher and therefore they had good results. That was a big factor. It was also because the way in which they're running the company, well, this is what investors are thinking, the way in which it is being managed, its production, all of that is getting better. So that perception then of the future of Valterra has changed.
Definitely, and that is why we always have buyers and sellers, because we get the very same kind of information, but we interpret that differently. That, listen, going forward, I don't think maybe there's value here, let me get out. But yes, if you are able to sell anything at a good price, and whatever that you are selling, you are able to produce that at a reasonable cost, then definitely that will increase your earnings, and earnings, as we know, those are profits. So just the basics like that is costing me 5 rand. I'm able to sell that for 80 rand, then definitely that's good money for you. And definitely, as he said, that we only make money when the share price go up. And why is it going up? It's because the company made good earnings, and also they'll be able to pay us dividends out of that. And we can use all this model, your discounted cash flow, and maybe that is why the guys got it wrong, even the guys who made that formula. But at the end of the day, it's a perception. We can apply all these metrics that we want to apply. But if I strongly feel that this company will do much better, then definitely I'll be prepared to pay more for it, and then be able to hold it up until a certain point. But what you said about perception, that's very, very, very important.
So, Gary, there are some companies that are sort of almost universally seen as, in inverted commas, good. A lot of them tend to be owned by Berkshire Hathaway. Okay. And yet, they were able to buy those shares from someone. Now, why would someone sell a share in a good company for anything, if you see what I mean? So even in our stock market, some companies are just perceived as better than others. ShopRite and Capitec are in a particular category, for example. Why would you ever sell your shares in those things?
Yeah, I think because you think you can do better in something else, or you.
So you need the capital is the question.
You might need the capital. Maybe you have consumption requirements. Maybe you want to buy a house. Maybe you want to buy a yacht. There's, the market is such a complex organism, and there's so many different players all making independent decisions, and the decision to sell can be there's multiple reasons why you might need to sell a stock. The question that I think does come down to valuation as well. So you say ShopRite is a brilliant business, and I think ShopRite is a brilliant business, but ShopRite is a brilliant operator as well. You look at 60/60, you look at like how their DC networks work. It's a great business. You go and look at the operations of ShopRite, you would say probably that they're materially better than something like Spar, but you've got to look at the valuation as well.
Yeah.
You have to pay up for ShopRite's earnings, and you're probably paying almost twice in terms of the earnings that you're paying for when you buy ShopRite versus Spar. So many people look at that, to Marco's point, and say, well, I'm paying a lot for it. It's a great business, but I'm paying a lot for it. And now all those future cash flows, I've paid up for them. So my kind of IRR, my ultimate return is going to be lower. If I think that Spar is going to turn things around and become more like ShopRite, and if they can duplicate, the model that ShopRite's using, why can't Spar go from, let's say, a 10 PE to a 20 PE? That's an awesome investment case, even though maybe the operations aren't as strong as ShopRite today. Again, it comes down to that future perception of what is going to happen within the business. And if you might have a great holding in ShopRite, but if you think Spar has a better chance of taking market share, if they have a better chance of turning around their operations and you're paying a lot less for it, it's easy to see why you might switch from one to the other.
Okay, no, that does make a lot of sense. Makwa, interest rates. I mean, interest rates really have a big impact, and especially the perception of what's going to come next. So presumably the lower the interest rate, which also means the lower inflation is, the better for the stock market.
Definitely. Remember, consumers, companies, they've got debt to repay. So interest rates, if they're high, then it means their repayments will be high. And then in the environment where interest rates are high, then that also not working, in the right way for consumers, and it's got a negative effect when it comes to the real economy. And take South Africa as an example. More than 60% of our economy, just like most developed economies, are driven by consumer demand. So if consumers are under pressure, then unfortunately those particular companies won't do that great, earnings won't be right. Then, as we said earlier, if a company is not making good earnings, then there's no need for that share price to go up. And as he said, when it comes to the forward PE of that particular company, then you might have a problem that I don't think this is worth it. So that has a very important part. Hence, you'll hear ordinary people say, like us, that we want an environment where interest rates are down, because that also in a way stimulate your economy. And if the economy gets to be stimulated, then it means those particular companies as well will grow.
Gary, this affects certain shares more than others. You'll often see financial shares react in a particular way to an interest rate announcement, for example.
Of course, because different, a company that, to Michael's point, has a lot of debt on its balance sheet and, needs to refinance that debt, and suddenly they're refinancing at higher rates. Their cost base is coming out. I mean, in the simplest form, your top line minus your costs gives you your bottom line, and suddenly your costs are going up, that makes you quite sensitive. But again, also to Michael's point, you've got, this is not just it's not just an income statement question around the company. It's also who is going to purchase this, like how much cash is flowing through the economy. So yeah, absolutely. There's that kind of, vicious and virtuous circle depending on which direction the interest rates are moving in. And it has a huge impact, and it just depends how exposed that underlying company is. The retail sector, for example, is very, very sensitive to interest rates because of its exposure directly to the consumer. The real estate sector also very sensitive to interest rates, because generally you have some sort of LTV in there, and there's the cost of capital is important. You're going to go get a bond and buy a property in the simplest form. If that bond is more expensive, or your income can't allow you to borrow the money that you want, you can't pay up for that property anymore, and suddenly there aren't that many buyers anymore, and there's more sellers than buyers, and technically it goes down. But I think just one other point, with interest rates as well, like in the kind of markets that we operate in, globally at the moment, there's also an incredible amount of leverage. So there's actually a mechanical effect of increasing interest rates, because suddenly the cost of borrowing money to buy stock, which creates almost an artificial demand, becomes more expensive. That cost of capital is more expensive. So interest rates go up, suddenly your repayments on that debt that you've now used to buy, equity securities, that goes up as well. Suddenly you start trimming because you want to try and reduce that cost, and that creates a lot of selling in the market as well. So there's also there's a mechanical element to this as well, that higher interest rates, specifically in highly leveraged economies, or highly leveraged markets at least, tend to have downward pressure on prices.
If I may add on that, hence you'll hear people talking about carry trades, that you go and borrow money, in an environment where the interest rates are low, and then you go and put it.
And you bring it here.
Exactly. Then you make the money, but yes, you still run the risk of exchange control that it can move against you. But the principle, as is saying, that's the basic principle: getting it cheap somewhere and then make good money somewhere.
So there's another thing around market sentiment, which is often irrational. So you will have a whole group of shares all going up at the same time just because people are feeling good, And they'll often say, did something happen at the World Cup last night that led to that? And I mean, it doesn't really follow. But any good economic news affects sentiment, and any bad economic news affects sentiment. And I mean, often, even though nothing has changed, Makwe, to say the fundamentals, the share price still will go down, which never makes sense to me. There must be buyers who look just for those moments, because they'll get good value there.
Definitely, you are right. Sentiment plays a crucial role, and unfortunately, one sector negative sentiment might have an impact on the general market, and profit taking kicks in. And truth be told, carriers, to be honest for once, sometimes we don't know what is happening. We just want a reason to say all because of 1, 2, 3. But it boils down to, I feel I made enough profits, or I've got my fear, that let me get out before it gets worse, or maybe that, whatever I've made, let me remove my chips from the table. So we don't really have answers to all the questions, but don't tell anyone. But you are right. Sentiment continues to play a very critical role. Fundamentals are okay, but people get out.
I admire the honesty, Makwe. You're with the Investment School tonight. We're talking to Gary Boyson. He is a portfolio manager and director at Rand Swiss, and Makwe Maselela is the founder and chief investment officer at Makwe Fund Managers, getting under the skin of share valuations. 11 minutes to 8.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
The Money Show.
Investment School.
9 minutes now to 8 the time. Investment School this evening. Gary Boyson's portfolio manager and director at Rand Swiss. Makwe Maselela, founder and chief investment officer at Makwe Fund Managers, talking about how you actually calculate the value of a share. Why is it that they sell at certain prices and not at others? Makwe, these things are never fair, right? And timing can really matter. So the underlying value of a company cannot change. The actual future of it cannot change. But if you decide to buy it during a period when very few other people are moving, maybe it's a public holiday Friday or something, you can actually find it quite difficult. If liquidity is low, the prices can be very unpredictable.
Definitely, because now that talks to what you said initially about the demand and supply. Then it's got not a clear reflection of the price itself. It's a question of, as you said, liquidity. And I think we usually experience that as from the 16th of December in our local market, we get a lot of that. But yes, timing is very difficult to time these things, but it's very important where you got involved, because hence we have bargain hunters, people getting involved, at a very low price, and then the guys will be able to get better profits versus someone who just got involved at a higher price. So yeah, only if we know how to time the market. But yes, it's very important. Your entry point, where did you manage to get involved?
Gary, we need to talk about technological changes. I mean, one of the reasons is very interesting when people say, but why do stock markets always go up? And over time they do. And it's partly because there's so many more companies. It's partly because that sort of technological change is quite relentless. Things become more efficient. We were talking about small businesses earlier, and the software, the way that you need to manage your money with your accounts is now free, pretty much. The most expensive thing is probably Eskom's electricity. Whereas in the past, it would have taken so much time and pen and paper and all of that, and that would have cost money too. So technological change has a really big impact. And one of the things that's so interesting now, when you have a technology like AI, which I know you and your mate Viv talk about all the time, is that we don't know the nature of it. And that's why share prices are so unpredictable.
I think it goes to what you're saying about, the Berkshire Hathaway, and the Warren Buffett philosophy of buying companies, with predictable cash flows as well. And one of the challenges in investing in technology stocks or technology companies is that you're paying for future growth. And so often, specifically at the frontier of technology, you have no idea what that's going to look like. You can kind of speak to the CEOs, you can speak to, you can try your best to understand the underlying technology and how the world is going to change. But I remember that, when nanotech started becoming a big thing, and it was going to solve everything. And we're talking about longevity, and there was all this hope for the technology, never really materialized. And I think that's the challenge with investing in technology. Like you're taking this bet on the future that's so uncertain. And that's where sentiment comes to play a huge role in it, and why you can see these huge swings. Because it's that level of uncertainty, and why I think you get a lot more stability. When if you're buying Coca-Cola, you kind of understand they're going to sell X amount of Coca-Colas next year. You know what that cash flow looks like. So the volatility drops out, and the risk of the investment, significantly reduces. Unfortunately, when you do have this paradigm shifting technology coming to the market, there are also super normal profits to be made if to Marco's point, if you get in at the right time, if you know, and if the technology and your thesis plays out the way that you expect. And it all comes down to your own personal intrinsic value on that stock, whether there's price discovery or not. It's if you call the move correctly, you generally are rewarded, with above average returns.
Makwe, politics. For every election I've covered, someone's asked me, what's this going to do to the JSE? And it's usually impossible. Our elections have usually been very peaceful, so, nothing. But long-term stability is really good for markets. One of the reasons the United States is so complex right now is because the politics is frankly unstable.
Definitely. Generally markets like certainty. And political certainty is also very important. And people need to be comfortable that you won't be coming with radical or ideas that won't be business friendly. Hence, now and then people canvass or campaign on how friendly their policies are towards business, which is critical, because without business, then unfortunately we'll have a disaster. So yes, politics will forever play a crucial role. And even when you don't have elections, but something just, unexpected happens, then unfortunately that might have a negative impact on the markets. But yes, politics is very important. Hence, at some point, we had people as political analysts who were working full-time in the markets doing reports, just purely on the political climate, and meaning portfolio managers needed an input like that what is the political situation and what can they expect going forward.
And Gary, now geopolitical risk has become a very important part of that. So, maybe there would have been South African political analysts. Now you need someone who can really tell you what's happening with Ukraine and Russia. I couldn't tell you that. And you need to know, is that war going to move? Could Ukrainian wheat suddenly flood the market? Could it be withheld from the market? Those things start to really matter.
I think they definitely matter. And politics, I think, as Marco says, it's always going to influence markets. But I think also, when you're an investor, I think we sometimes overcomplicate it. You look at a portfolio and you think, I have to know what's happening in Russia and Ukraine. I need to understand exactly, what is the situation in, between the US and Iran at the moment. Again, it comes down to, you're talking a lot of Buffett tonight as well, but it comes down to stay within your circle of competence. Understand the business. Understand, are there commodity price pressures? Is the wheat price going to affect this business? Yes, then I probably need to know what's happening with Ukrainian wheat exports and how that's going to impact the market like we saw in 2022. But if you're investing in a new technology, or if you're investing in a business that you understand very well, you understand the customers, how much is the war in Ukraine going to impact Coke sales, for example? Is this going to stop people drinking Coca-Cola? I think probably health trends are going to have more of an impact than a war. So I think you need to, I think the first step in constructing a good portfolio and instructing a good investment philosophy is to understand the businesses that and there's always an option not to invest. You don't have to go and speculate on oil because there's a war in the Middle East at the moment. You can avoid the whole situation and focus on things that you understand well and that you can see discounts in, and that you feel will be longer term good investment prospects.
Gary Boyson, thank you very much indeed. Gary Boyson is the Portfolio Manager and Director at Rand Swiss. Makwe Masalela is the Founder and Chief Investment Officer at Makwe Fund Managers. Gentlemen, really appreciate you both coming in. Thanks very much indeed. Investment School, a bit like the revolution, will of course be podcast. It's so interesting to see some of what creates the value. So often I've found, in my experience of it, it really is just all about timing. When did you get in and when did you get out?
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
Well, sentiment running very nicely in the United States tonight. The Dow Jones is up 1%. The Nasdaq is up 2.5%. And the S&P 500 is up 1.41. And really, as you heard Viv Govender earlier, it is partly about Microsoft's results, which beat forecasts, and that had quite a big impact on their share price. Meta, on the other hand, going the other way. Investors just not convinced really about that. And then, of course, the interest rate hold last night in the United States having an impact and helping the Rand as well. We're back tomorrow. Sierra's up next. Good evening. It's 8 o'clock.